Thank you for joining me tonight for an update to what has been a pretty crazy and wild few weeks with the California Dream for All program. So most of you are here because you already know about the program, you know what it was, and you're aware of the fact that, well, the program's out of money, that just as quickly as it started, it ended or paused. And my purpose tonight is really to talk to you about what that means. What are our options now that the program has paused, and really help you understand how to make decisions based on, well, I was planning on using this program and I thought it was a great option to help me buy a home. And I want to walk you through, is that still the right direction to go? And it may very well be. Or do we figure out a different way to buy a home and help educate you on as much as I know right now on what's happening and what the next steps are going to be. So let's go ahead and dive in and kind of give you an overview. So first of all, I'm going to talk, this is the agenda of what I'm going to cover tonight, Q&A. So this is going to be broadcast on my YouTube channel as well. So if you're watching this recorded on YouTube, you can put questions into comments and I'll respond. Also, the live audience here on Zoom, you can absolutely ask questions in chat and I will get back to you and answer them as we go. So what am I going to cover? Well, first of all, will we see more dream funds again? And if so, is the program going to look the same? That's a big question. And a lot of people are wondering, should I wait for it to come back? You know what, I'm going to talk about a rent versus own wealth building calculator to give you kind of an idea of what the cost is of not being a homeowner. And then we're going to talk about options if you don't want to wait. You know, what can I do if I'm not going to wait for the Dream for All program to come back? What are my options right now? So that's really my goal to get through tonight, and I appreciate you all being here. So let's go ahead and dive in and get started. All right, first of all, are we going to see dream funds again? Well, the answer is yes. The unknown is when and how much. What do I mean by that? Well, the program was created as a perpetual program. I'm going to have to get a frog out of my throat. Give me a second here. And when I say it's a perpetual program, what I mean by that is that it is intended to be self-fulfilling, that once the state puts enough money in there, as people enough money in the fund. The fact is, the state only put $300 million into the program. It was designed to have 10 years of annual additions of money. We're going to start out with 500 million the first year, and they allocated that. And then in January, they dropped it to 300 million. And then the second year through the 11th year, 10 more years, they were going to put $1 billion each into the fund. Now that's still the plan, but I did some digging in the last 48 hours into the state budget, and I couldn't find the exact number, but I found 2 references to the fact that they cut the amount of money they're going to put into the program next year. And the question is, when is next year? Because technically, the state budget runs from July 1st of 22 to June 30th of 23. And so it was in that budget, the 2022 to 2023 budget, that money was set aside, this 500 million. Halfway through the year in January, the government always does, state government does a refresh of how much money is in the budget versus how much money do they have allocated to spend. And they realized they had a shortfall. That when they started out this year on July 1st of 2022, they thought, oh, we have enough money to pay for all this stuff. In January, they realized, nope, we're short. So in January is when they cut this money from 500 million down to 300 million. Well, they already have their numbers proposed for the next budget year of 2023 to 2024, July 1 of 2023 through June 30th of 2024. And there's already footnotes saying that they have decreased their allocation into the Dream for All program. Now, I'm kind of encouraged that that fiscal year starts July 1st. There's a chance they're going to pump money right back into it on July 1st. I'm not counting on it. As a matter of fact, I'm a little concerned the first time we're going to see money again is going to be July 1st of 2024. Now, I don't know, and there's actually an informational meeting that I heard about that is coming up in the next few weeks that I'm going to try to attend, that is kind of the committee that created this program is going to be doing some digging into, hey, what happened? Did it work? Did it not? Well, I got a lot of input on it because I've got a lot of clients who tried to use the program. I've got some that are in process with it right now, and we're running into major problems. So those of you who wanted to get it and didn't, you actually may be better off. And I'm going to explain to you in a minute why you might be better off. But let me be clear. There will be more money coming. The question is it going to be coming up in July of 2023? There's a chance. If it doesn't show up then, we're probably looking at either January of 2024 or July of 2024. So that's kind of an idea of how long we're going to be out. But here's the reality. The reality is we went through $300 million of loans, and that's only for the 20% second mortgage, which means we did 1.2 billion, actually 1.5 billion dollars of home sales volume that were complete, that were locked, went into contract and locked in 8.5 business days. They launched this the last Monday in March, and that Friday was Cesar Chavez holiday. The state of California was closed. So we had 4 business days the first week. The second week was the first week of April. We had 4 business days, and at the end of Thursday night, they said, hey, we're almost out of money. We think we're going to run out next week. And the next morning, it ran out by 11:30 a.m. So this money lasted $300 million, lasted 8.5 business days. That was absolutely crazy. And what it created was it created a frenzy of buyers. And if you were out as one of those buyers, you saw that people were offering way over asking price for the home simply because they didn't want to miss the chance to get their assistance money. But here's what a lot of people didn't understand. Even my clients who I told this to didn't fully understand it. The money is reserved for you for that property. So if you cancel the property, if you do a home inspection and you don't buy that property because you found a problem with the home, you lose your reservation you had on the money. You cannot transfer it to another property. So you've got buyers who bid way over the asking price. And it reminds me of 2020 and 2021, when we had a frenzy of buyers that were trying to buy homes. And those buyers would do anything to get a home, and they would waive their inspections, they'd waive their appraisal contingencies, they'd waive their loan contingencies, and they'd offer significantly over the asking price. Well, guess what? There was a lot of buyers having buyer's remorse. They were feeling like they made the wrong decision, but they felt like they couldn't cancel because if they canceled, they'd never get a home. Well, guess what? Over the last 2 weekends, that's exactly what the market looked like again. So this program is now putting people in a situation where they have to choose to keep the home that they may not necessarily have the desire to deal with, and they have to choose to accept issues with that home, or they lose their opportunity to get dream funds. That's not healthy. And that's really going to create a question about how are they going to redesign the money. Let me finish this slide. 2023 money was cut by 200 million. 2024 money was cut, but I'm not sure how much the amount is going to be. But here's the question. Is the program going to look the same? And I doubt it. And it's for the reasons that I just explained. The money went too quickly. And I actually did a video today, so you can see it on my YouTube channel. Search California Dream for All or John Lone King on YouTube, and you'll see I did a video today that said, hey, those that were lucky enough to get their dream program funds reserved may not be so lucky because there's a huge backlog now. CalHFA has 2,500 loans that they have to get through their system in the next 30 days. So they've got to change the program in order to slow down the pace. They've got to slow down how quickly people are using it. They've got to slow down how quickly the money runs out. And I think there's a lot of ways they can do it. I think that, Gary, you asked a great question. Gary posed a question here. I'm actually going to address it right now. Gary said, what happens to the Dream for All money when these homes fall out of escrow? Do you think there'll be a large number of homes falling out of escrow? Yes, I think there's going to be a lot of money left over. I think I already know of a fair number of buyers. One of my colleagues had a buyer on they'd reserved their money the first week. During the second week, right when the money ran out, they found some problems. Before that money had run out, they found problems on Wednesday of the second week. And they said, oh, well, we're not going to buy this home. We'll cancel and we'll put an offer on another one. And they canceled it on Wednesday night, and they put an offer on a home, and they got it accepted on Friday afternoon. And the money was gone. Now, the cancellation didn't get processed until Friday afternoon, because we can't cancel a loan in the system until we get the written cancellation notice. So that money was already part of the allocation that CalHFA said we've already allocated all the money. So there are people who have already canceled and that money is left. There are people who are going to cancel. And unfortunately, there's people whose sellers are going to cancel on them. And it makes me very sad. But there are sellers right now that did a 30-day escrow starting on April 1st, and they expect to close by April 30th or May 1st. And it's not going to happen. I think CalHFA is going to get backlogged 30 to 40 days real soon, like real quick. And you can watch the video that I posted today and I explain why I think that's going to happen. But the bottom line is that the loans are going to fall out of escrow. There will be money left over. CalHFA has not told us what they're going to do. But I'm not going to be, I think it's going to be a very tough situation if they make an announcement that says, hey, starting next week on Monday, we have $50 million available. Okay, well, 50 million sounds like a lot of money, but 300 million disappeared in 8.5 business days. So 50 million is only 1/6 of that. That means it's going to disappear in a day and a half. And there's no way you're going to get an offer accepted and get your reservation in that day and a half. And it's going to be a frenzy like it was that Friday morning last week, where every lender was trying to lock loans and it collapsed their system. It was a nightmare. I won't get into the details on that. But here's the deal. I wonder if they're not just going to set that money aside and wait until they revamp the program, because it's clear that they were too generous. Now, they might not change it, but it's going to create the same problem again next time. It's going to create the exact same problem where you have too many people trying to buy at the exact same time. There aren't enough homes for sale. And so we're going to end up creating a buyer frenzy that's not healthy for the market. And it's going to make people sure they can get assistance, but they paid higher for the home price than they needed to. And so are they really getting help? Because if that program didn't come, they could pay a lower price for the home. I'm torn. I'm a fan of the program in general, but I think that I certainly underestimated. If you guys have watched any of my webinars or videos on my YouTube channel, I thought this would last, maybe 3 months, maybe at one point I was thinking 6 months that the money would last. Clearly I was mistaken. And this money went a lot faster than we expected. And so that's going to be the challenge as they launch the second wave of money. The question is, will they hold the money that they have right now that's extra for that second wave? Or are they going to throw a little bit of it out there that I believe is going to get eaten up by people who are currently in escrow? Let's think about it. A big portion of the money that was released 2 weeks ago went to people who were already in escrow, that said, hey, I got an escrow going right now and I'm putting 10% down, and well, why don't I just convert to this program and now I can not put my 10% down and keep my money in the bank? And there were a lot of buyers who converted their active escrow. And I think that whatever money is left over when they release it is going to get eaten up by escrow conversions. And the people on this call who are saying, John, I feel like I missed out, you're not even going to have a shot. And I don't mean to say that to be discouraging. I'm saying that just to be factual. I think that there's no way for them to stop people from converting active escrows. And very few people are going to have the timing perfect that they're able to go out and write an offer and get it accepted and get it locked right at the time that the money's available, when there's only going to be a fraction of money compared to the 300 million that disappeared in 8.5 days. So I think the program is going to look different. There's going to be a hearing next week that I'm going to be participating in. But here's the simple thing that I already said. There has been way too much demand on homes, and there are nowhere near enough homes for sale right now. It helped way too few people. The fact is, as much as I would love to have all of you guys get a 20% down payment and from the state, I think it's smarter for them to limit the funds per person. Now, maybe they limit the funds on the higher end of the price range, and maybe they say, hey, you can get 20%, but no more than $100,000. So if you buy a $500,000 home, you get 20%. But if you buy $1 million home, you only get 10%. I'm not in charge of this. I don't make the rules. They don't even ask me. But I think that's the kind of idea that would be logical, that would stretch the money out and help more people. Now, once we get $1 billion in there, well, that's 3.5 times the amount of money that we put in there last week, 2 weeks ago. But guess what? That only means it's going to last 25 to 30 business days instead of 8.5. If the appetite is as much as it was, and I think it will be, the money's going to go quick no matter what. They really need to consider shrinking the amount of money per person, because I think that's going to help a broader audience of people, and not, you got a lot of people who bought $1 million homes that got $200,000. Now, I'm not faulting them, because maybe they bought in the Bay Area and that's what the price point is there, but it ate up a lot of the money very, very quickly, and it created the situation we're sitting in today. So let's keep going. The question is, should I wait for the money to come back? That's the $1 million question. And here's what I'm looking at. First of all, you have to think about, where are home prices headed? Are we going to see home prices go up, go down, or stay the same? Well, nobody has a crystal ball. So nobody's going to be able to predict for me or for you where home prices are going to go. But I have been saying for a long time that I firmly believe house prices have come down in the last year for one reason and one reason only, and that's because interest rates went up. There's a whole bunch of buyers that want to buy, but they were sitting on the sidelines because they don't qualify for the current monthly payment because rates are up, or they're unwilling to pay the current monthly payment because rates are up. Well, guess what? This program allowed all of you who are in one of those two positions and say, hey, I don't qualify, or I'm just unwilling to pay it, to say, you know what? Now I'm willing to pay it. Now I do qualify, and I'm going to jump in and buy. And guess what we saw? Huge increase in demand. Well, what does that mean? It means that when interest rates come back down, and they will, I can't promise you when, but I can promise you that they will. Everything in life is a circle. And the problem with humans is we believe whatever's happening today, it's going to be that way forever. And the truth is, no matter how good things are in your life, and no matter how bad things are in your life, they're never as good or as bad as you think they are, and they're never going to stay that way. It's just reality. And so when you think about, hey, what's going to happen with the interest rates, they're going to come down. It's a cycle. We are headed towards a recession, and interest rates historically drop during recessions. The fact of the math is that right now at a 6 to 6.5% interest rate, when you got 20% of the purchase price that the state paid for, so that you only made payments on 80%, that payment on the 80% is the same payment as if the interest rate was at 4.25%. So when interest rates drop back to the 4s, everybody who said, I'm not willing to pay this high payment, or I'm unable to qualify for this high payment, they're coming back into the market to buy. And they're not going to wait until the moment they come into the 4s, because some of them will feel better when rates are at 5.5, and more of them will feel better when rates are at 5, and even more will feel better when rates are at 4.5. So we have a problem with not enough homes, because people are aging in place, meaning the cycle of home ownership. You buy your first home, you live there until you're in your 30s, you start having a family, you upgrade to a bigger home so that another first-time home buyer can have your home. And then you stay there until your 40s, and then you buy your top home, your luxury home. You're in your peak income earning years, and you get your third home, which is your nicest home. You're there until you're in your 50s, maybe early 60s, and then you downsize. You're getting ready to retire. You want to lower what your overall debts are. You buy a smaller home again. And then at a certain point, you move into an assisted living facility, you move in with your family, you pass away, and you don't need the home anymore. And your home, that smaller home, becomes a starter home again for somebody else. It's the circle of housing. The problem is people are living longer. Now, that's not a problem. I don't mean to say that's a problem, but from the cycle, it's a problem. People are living longer. So that home that they're in, that's not being freed up for that first-time home buyer. And the guy who bought that first home 5 years ago, he's not moving up to the next home because interest rates have shot up and the prices have shot up. So there's not inventory that's being freed up like it normally is. So as soon as interest rates drop and there's not more homes to buy, the prices are going to skyrocket. All of those buyers are coming back in the market, and the last 2 weeks proves that fact. So in California, in the United States, but specifically this program was in California, we have proof that there is a huge amount of demand. Everybody says, oh my gosh, Sean, I'm going to wait, the housing market's going to crash. If prices dropped, every single one of you would immediately jump in and try to buy a home. And we just saw $150 million worth of homes get sold in 2 weeks, because not 150, $1.5 billion of homes get sold in 3 weeks because we had $300 million of assistance money sitting there. So the demand is there. And if you wait till next year, the good news is interest rates might be lower. And that's the truth. I think that interest rates are going to be lower next year. So you could have a less expensive payment next year, but you're going to pay a lot more for the house. Versus if you buy a house now, you got to bite the bullet and have a higher payment. We'll talk about that in a couple of minutes. But if you buy a house now, you're going to be ahead of the curve because you're going to have equity as everybody else is starting to buy when rates go down. And you can use that equity to refinance, lower your mortgage payment, get rid of your mortgage insurance, pay off that little bit of down payment assistance money that you got instead of a huge chunk of down payment assistance money. And you're sitting pretty in a year or year and a half when everybody else is bidding wars on these homes, and you bought a home without having the bidding wars, and you're able to bite the bullet a little bit for a year or two, and then be able to refinance and have a significantly lower monthly payment. So that's really the key here. Is I think that this program is going to significantly increase prices when it's released. So if you're waiting for this program to be released again, and I'm not saying you shouldn't, but I'm saying be aware of the fact that, hey, I already said I think interest rates are headed down. I already said that I think housing prices are going to head up, and that's without this program. Now you throw this program in like what we saw over the last 2 weeks, and we're going to see a bonfire of activity of people trying to buy homes. And when you have a whole bunch of people chasing very few homes, they're going to bid up the prices, and it's going to be even harder to get your offer accepted. And so many of you saw that over the last couple of weeks. So in summary, do I think you should wait? Well, if you can't find a way to afford the payment, you don't have an option, you have to wait. But if you can find a way to afford the payment, and I'll show you in a few minutes some ideas of how, or find a way to come up with your own down payment, and I'll show you in a few minutes a couple of ideas of how, then it is far better to do it now than to wait and do it later. It is clear we have a housing shortage. And if you want to understand my explanation of why, I have a video that I did back in January that is my 2023 housing and mortgage economic outlook. And I spent 45 minutes talking about going back to 2005 and all the way through this year, what happened with housing, what happened with something called household formations, and what happened with demand. And I gave you a good 45 minutes in that video of why I built my case to why I believe housing prices are going up, why I believe interest rates are going down, and that you're going to be in a far better position to buy now than to buy later. But here's the other side of it. Let's pretend housing prices stayed the same. Let's pretend interest rates stayed the same. And let's pretend that a year from now, you can use this program and buy exactly the same as what you're buying today. You've lost a year of wealth building through homeownership. Now, what does wealth building through homeownership mean? Let me show you. So this is a really simple, overly simplified breakdown, but it says, hey, if you bought a $500,000 home and you did an FHA loan, let me get my little handy dandy spotlight thingy here. All right, cool. So you buy a $500,000 home and I gotta move this thing out of the way. There we go, you're out of the way now. You buy a $500,000 home, you put 3.5% down on an FHA loan, your rate's at 5.75, you're going to have a monthly payment, including taxes and insurance, of about $3,600 a month, $3,700 a month, okay? But the key to this formula is I'm comparing this to, let's pretend that you've got somebody who is paying $1,800 a month in rent, or you're paying $1,800 a month in rent. So I'm looking right here, I put in your estimated rent. By the way, this is a calculator, a spreadsheet I can run for any of you, and we can plug in your exact numbers. And so what I'm showing right here is, hey, you're paying $1,800 in rent. So if you're renting, you get zero tax savings. The federal government gives you nothing to help you offset your taxes as a renter. They give you a good tax write-off. Now, I underquoted this. I put 12% tax bracket because the truth is the tax savings is, the tax bracket's way higher for anybody who's buying a home in today's market. But you're not going to save on all of your money because you have what's called the standard deduction. So you got to talk to your tax preparer. I really underestimated this tax savings because the other two are actually more important and they're applicable across the board. And the second one is what's called forced savings. Forced savings is the amount that you're paying down your balance on a monthly basis. Now, what does that mean? Well, your principal and interest payment that you pay to the bank, now you have taxes, insurance, and mortgage insurance on top of that, but your principal and interest, the interest goes to the bank, but the principal goes into your equity. It's paying down the balance of your home. So when somebody says, oh my gosh, I can't afford to go from $1,800 a month in rent to $3,600 a month in a mortgage payment because that's doubling my payment. Well, the first thing is you've got $500 a month of that payment that is going back in your pocket as savings. So if you're putting money into a savings account, you can stop doing that for the time being because you're replacing the $500 you're putting into a savings account with the $500 you're using to pay down your equity. It's called our forced savings account. So you're going to still get that $500 a month of savings. You're just putting it into the equity that you're not going to be able to touch until you sell the home or refinance and pull some cash out. But you're still saving the money. It's the same thing as our 401k. We put money into the 401k hoping to never, ever touch it. Don't think about it. It's gone. It's not my money. Well, that's kind of the same thing as your mortgage. You're putting this $500 a month towards the principal. Don't touch it. Don't think about it. It's gone. But you're building wealth for the long term. $500 a month automatically paid down towards your equity. And then the biggest one is appreciation. Now, appreciation with the California Dream for All program, the state got 20% of your appreciation. But if you don't use the program, you get all of it yourself. That means, and I used a low number of 3% annual appreciation. That means that your $500,000 home, just in the first year, average, is worth $515,000. It went up $15,000 in 1 year. That divided by 12 months is $1,250 a month in appreciation in equity that is savings, that's wealth building that goes into your future wealth. So what does that mean? That means that we've got about $2,100 of money each month. Even if you subtracted out the tax savings, you're still looking at $1,750 a month that is being added to your future wealth. Why does that matter? Because it means you can slow down or stop temporarily the other savings you're doing. Maybe you're putting money into the stock market. Maybe you're putting money into your 401k. Maybe you're just putting money under your mattress or into savings. Well, you can do that again once you refinance down the road at a lower rate and you get your payment down. But for now, you can slow down or stop those savings because you're getting $1,700 a month. So just with these two things, your mortgage payment of $3,600 is almost exactly the same as your rent cost because you get zero tax savings as a renter, you get zero equity into your pocket as part of your payment going into your pocket, and you get zero of the appreciation. Your landlord doesn't give that to you, but you're getting all of that as a homeowner. All right, I want to make sure you guys are still awake. So if you have any questions, please post them into the chat. If you're watching live, if you're watching recorded, post them into YouTube, and I'll get back to you and help answer your questions. All right, so let's move on to, okay, John, great. You've sold me on the fact that I should buy a home. You've sold me on the fact, by the way, I'm not selling you. I've decided that I don't want to wait, and I've decided that I don't want to lose that year that I'm waiting, that I don't get that appreciation, I don't get that forced savings, and I don't get that tax write-off. So what are my options if I don't want to wait? Well, first of all, you got to figure out, A, can you come up with your own down payments to replace the money that came from the state or a portion of the money that came from the state? Here's some ideas. First of all, you can get a gift from family. Now, gifts from family, people misunderstand and say, oh, I can't get a gift more than, the whatever, $16,000 that the IRS allows every year. That's not true. You talk to your tax preparer, but I'm not a tax preparer. I can't give tax advice. But the fact is, you can get a gift for as much as they're willing to give you, and nobody pays any taxes on it. Until somebody, the donor, your grandma, your parent, until they give away over, I think, a couple $1 million of money over their lifetime, that's what the IRS is tracking, to make sure that somebody who's a gazillionaire isn't giving away all of their money, $2 million at a time, so that they don't have to pay inheritance taxes. But if your family member gives you $50,000 or even $100,000 to help you with down payment on your home, there is no taxes that you have to pay. There is no taxes that they have to pay. What are some other options? Take a loan from your 401k. I talked about the fact that you're going to build so much wealth through home ownership that, yeah, maybe your 401k, you're not going to build as much wealth through the 401k temporarily, but you're going to get more wealth out of home ownership than you are out of your 401k because of leverage, which also gives you the option of a 401k withdrawal. I've had some people, I'm not telling you that you should liquidate your 401k. As a matter of fact, I think it's one of the last options you should do. But if it's the only way, to own a home, I would consider it. I would 100% consider it. And Randy, I see your question. I'll get to it in a second. And a lot of 401k programs, you have zero penalty for early withdrawal if you're using it to buy your first home. So check with your HR department, your 401k provider, but that's an option. Raina says, what's the best way to provide that gift? A check to title, transfer into the giftee's account. The best way is cash hand delivered to my office, and then we'll never talk about it again. No, I'm just kidding. Don't bring cash to my office. I'm just kidding. If you're going to get a gift from family, you need to talk to me before you do it, because it depends on what type of loan, whether it's conventional or FHA, depends on where the money is coming from. We have to paper trail the movement of money. So the specific answer in most cases is the best way is to have the donor keep the money until you're in contract and we have them wire the money to the title company directly. Now that isn't always the best way, but 9 times out of 10 it is. So if I'm going to give you a generic answer, that's the answer. But one thing you'll notice on a lot of my webinars is I tell people, don't believe something that you heard on the internet. Now here I am telling you something on the internet, but even I don't want you taking my advice, because my advice is generic advice and we have to customize the advice to your specific set of circumstances. Great question. I appreciate that. Can it come from family's equity in their home? Yes, but they'd have to liquidate it. So one of the cool things, so Rana says, can the gift come from family's equity in their home? There's actually 2 ways that I can interpret that. First of all, the family can take a loan against their equity and give you that money, no problem. But sometimes the best way to own your first home is to buy a home that belongs to your family member. And there's a lot of times that's an option. By the way, I'm not going to remember this, but I want to say it now. Another thing people don't do enough is to ask their landlord if they're willing to sell them that home. You can typically get a deal on the price of the home, and you can often use that lower price to help cover closing costs, because the landlord doesn't need to search for a buyer. They have the buyer right there. And if you're the one that approaches them, you have a little bit different approach on how you negotiate with the landlord. So if you're thinking about buying a home and you like the one that you're living in, please don't forget to ask your landlord if they're considering selling their home. And if they were, would they consider you? Now, the landlord cannot give you a gift of equity, but your family member can. So your family can say, look, the house is worth $600,000, but I love you, little Timmy, and I want the house to stay in the family, so I'll sell it to you for $500,000. But what I'm going to tell you is, tell grandma, thank you, grandma, but I'm going to buy it from you for $600,000. And then John said that you should give me a gift of equity. There's no money out of grandma's pocket. Grandma just gets the $500,000 that she wanted. But on paper, grandma's selling it to you for $600,000, gifting you $100,000 of that money, and grandma's getting the $500,000 that she wanted. It's far better to buy it from grandma at market value and get a gift of equity than to buy it for what grandma wants to sell it for, because now you have to come up with your own down payment. So that's a whole nother topic. I actually have a video on my John Lone King YouTube channel that talks about buying a home from family. And I spend, I think, 30-45 minutes talking through how all of that works. All right. So how else do you come up with money for your own down payment? Sell something. Well, what do you mean? I'm not talking about selling yourself. I'm talking about, don't sell your soul, sell your toy, sell your boat, sell that second car that you don't need. The truth is, look, you can't live in the boat. You can live in the boat. It depends on the boat. Some boats are nice. Maybe you can. But for most of you, you're not going to have a boat that you're living in. And so you need to decide what's more important. Is it more important to have the toy or to have the house? And if you sell the toy now and you get the house now, down the road, you can refinance the house. You can even pull out some cash to buy a new toy at that point in time. But we got to delay some gratification if we're going to make this happen. And that's really a key to thinking about how do we do this while selling something is one of the ways we do it. Another way you can come up with your down payment is to use down payment assistance. And I'll talk about those options in just a minute. All right. So the other option is, look, I can't come up with more money for a down payment, John. That means my payment's going to be higher because the Dream for All program was going to pay for 20% of my price of my home. I only had to pay on 80% of the home price. That's why I liked it. If I go with these other down payment assistance options, I got to pay a higher monthly payment. Well, that's true. And so sometimes it means you look for a little less expensive home. Maybe you compromise on the neighborhood, you compromise on the size. Don't compromise and accept a home that's broken that you're not willing to accept at the price they're selling it for, but compromise on something else. What is a must-have versus a like-to-have? And make sure that you understand what those things are so that you can say, hey, maybe I'm going to buy a lower priced home so that I have a similar monthly payment. But for a lot of people, that just isn't going to be an option. So we got to figure out, how do we afford to pay a higher monthly payment? First of all, decrease your 401k contribution. I hope you've gotten a theme here today. You're going to build a lot of wealth through owning a home. So if you're putting 6% of your pay into your 401k, maybe for the next couple of years until rates go down and your equity goes up, you slow down or eliminate putting money into your 401k. That's an option. Decrease your money going into other savings or investments. I told you earlier on that $500,000 home, $500 a month is going towards your equity, is money that's paying down your balance, putting money in your pocket in the future. So maybe you slow down or stop putting money into the stock market or stop investing money into other investments or stop putting money into savings. Maybe that's an option in the short term. Remember, house payments stay the same or go down in the future. Rent payments stay the same or go up in general. Now, those aren't both, neither one of those are guaranteed statements, but they're pretty close to it because your house payment is a fixed interest rate. Your taxes and your insurance go up a little bit, but over time you can lower your interest rate and you can lower your monthly payment. You can't do that with rent. In general, rents are lower, but they keep going up. A mortgage payment is higher, but it stays the same or goes down. And guess what? Your income goes up. So over time, you jump up right now to become a homeowner. You got this higher monthly payment. You slow down or stop your 401k contribution. You slow down or stop the money going into other investments. But guess what? Over time, your income's going to go up. Even if you never refinanced, your income's going to go up. And now you have more discretionary income to start putting money into the 401k again, to start putting money into other savings. As a matter of fact, if you end up taking this advice, I tell you that then immediately, as soon as you get a pay raise, you immediately take your amount of your pay raise and start putting that back into your savings because you were living without the pay raise and you were making it work. So take that money and immediately start putting it back into those savings accounts. There's a method to the madness to make this work. All right, sell a toy. I already talked about the fact that you've got, the boat, the extra car, et cetera. Well, guess what? Those come with payments. Okay, you have a really nice car and you love really nice cars, but again, are you really going to choose to have a really nice car that, hey, maybe it's going to appreciate a little bit in value? Most cars depreciate. Some really nice ones will appreciate, but it's rare. And the fact is the house is going to appreciate. The value of the house is going to go up a lot more than even the nicest boat or car across the board. And finally, nobody wants to hear this, but maybe you need to make some temporary lifestyle changes. That's the last thing I want to hear. Honestly, I hate giving that advice. I hate the guy that says, stop going to Starbucks. Your $5 at Starbucks is nickel and diming you to death. That's not me. But let's be honest, it is money. And so maybe you say, hey, you know what? For the next couple of years, we're gonna not renew our Disney season pass, annual pass, whatever it's called. I remember going to Great America as a kid and it was called a season pass. Now it's called an annual pass because, well, it's open all year long. Anyway, or Disneyland is anyway. So the point is, maybe you make some temporary lifestyle changes. Maybe you say, hey, for the next year or two, we're gonna spend our time in our backyard and have some staycations instead of traveling for vacations. because that's the compromise we need for the short term, because we can see the pent-up demand. You can see how many people are trying to buy homes once they can get a little bit lower monthly payment. All those people are going to be your competition as soon as interest rates come down and house prices are going to skyrocket. All right, so let's talk about down payment assistance options. Obviously, the DREAM program is a great option, comes at a cost, and I'll go through that comparison here in a minute, but there are other programs that are out there. So first of all, Cal HFA, same company, same government department that handles the DREAM program, they've had other down payment assistance programs for years. Their My Home program is the one that I'm going to show you in the next slide or two when I run my comparison of numbers for you. Their My Home program gives you 3 to 3.5% to cover your down payments, and it's simply a loan. You're paying 1% interest on the loan. The dollars are significantly less than what you're paying in shared equity, and I'll show you in a couple minutes how those dollars play out. So you can buy a home with 0 down payment. The only thing you have to pay for is closing costs. But you can ask the seller to help you pay for the closing costs if you're able to negotiate it, and you can still buy a home for as little as $2,000 out of pocket. CalHFA also has a program called the ZIP loan. Now that's layered with the My Home so that you can actually borrow money for your down payment and borrow money for your closing costs. Now the rates on those are a lot more expensive, and I honestly don't think it's a good deal right now, but as the market shifts, it might become a better deal again, but it's absolutely an option that I can help advise you on to decide if it's a good idea or not. And then you got the GSFA Platinum program. That program gives you anywhere from 3% to 5% of your purchase price. Part of it is a loan. Now, in the Platinum program, you have to make monthly payments on the loan. I'm going to explain that in way more detail in the next couple of weeks. I'm going to have a series of webinars and videos going really deep into all of these programs. So if you're thinking that this might be something you want to do, I'll show you in the end how we can get the process started now. But if you're watching this as a recorded video down the road, or if you're watching me live and you want to get the information in depth, I'm going to be doing webinars and videos going in depth to all of these programs and how they work. So the Platinum program and the CalHFA My Home and ZIP program, they complement each other. You can't use both, but in different circumstances. For example, some of them don't require you to be a first-time home buyer. So there's some ways that you can use a cosigner that the DREAM program wouldn't let you use a cosigner. But now you can actually qualify for a higher priced home because you can use a cosigner with some of these programs. So and the Platinum program has some grants built into it. If you are an employee of a school or a school district, or if you are a medical worker or a firefighter or a first responder of any type, there's lots of categories within the Platinum program that give extra benefits to people that have certain employment categories. So again, there's some special things that are built into all of these programs. And the other thing that truthfully nobody talks about, and I'm actually going to talk about this a lot, is the WISH program. You know, I'm recording this, what is it? Today's the 13th of April. And a couple of days ago, there was a mortgage company that announced a 1% down payment conventional loan. And every lender and every realtor is talking about it on social media right now, or at least the ones I'm friends with. And everybody says, oh my God, that's great. It's amazing. I want to call you and talk about it. Here's the problem. The problem is the income limit is super low. As an example, I'm going to use San Joaquin County as an example. In San Joaquin County, the area median income is around $85,000. Now, some loan programs like the DREAM program had special benefits if you were at 80% of that, or around $68,000. But this 1% down conventional loan that everybody's saying is such an amazing program, it requires you to make 50% of the area median income or less. That means you have to make less than about $45,000 in San Joaquin County. If you make less than $45,000, the home prices are well above what you can afford in a monthly payment. You're not going to qualify. It's smoke and mirrors. It doesn't exist. It exists, but nobody's going to qualify for it. So this WISH program is better than that, because here's what the WISH program does. The WISH program says, hey, you have to be under 80% of the area median income. So that's around $68,000 in San Joaquin County. I can help you with what it is in other counties. But what the WISH program does is it says, hey, we will grant you not loan, grant you $4 for every $1 that you bring in. That's right. They'll grant you $4 for every $1 you bring in, up to $29,000 and change. So that's you bringing in about $7,000, and they give you a grant for $29,000. You've got a total of $35,000. You have a total of $35,000 to put towards your down payment and your closing costs, as long as you're under 80% of the area median income. So it's a huge opportunity to help people that are in the low income threshold that, hey, you need to come up with about $7,000 out of your pocket, but you're going to get an extra $28,000 for free. It's an amazing program. The funds run out quick. They're replenished every year on April 1st, and they're typically gone within 4 to 6 months. Raina said, have you heard of the home loan for the duration of 40 years as opposed to an additional 15 or 30? So that's the other thing that's been going around on the internet and social media over the last couple of days, is that FHA is now offering a 40-year mortgage so you can have a lower monthly payment. No, they're not. What FHA is doing is FHA is modifying current homeowners who have an FHA loan and putting them into a 40-year loan because they're struggling making their payment. And so FHA is saying, look, we need to find a way to help people make their payment. And so if you're struggling making your payment, then you can use this 40-year loan. We're going to stretch you out for 40 years to help you make a lower monthly payment. A 40-year loan is a very little decrease in your monthly payment. They offer, I've been doing this for 23 years. 40-year loans were offered back when I got into the industry and up until about 2007. It was a minor difference in monthly payment. It might have made a difference, you know, instead of being, yes, correct, Raina, to avoid foreclosure. So the bank, FHA says, hey, so we don't have to foreclose, stretch out the payment for 40 years and see if that helps them. That's all it is. Now, could FHA later say we're going to do new loans for 40 years? They could do whatever they want, but that's not what they've said. That's not what they're offering. That's not what this new rule is. This new rule simply says to avoid foreclosure, we can stretch your loan out for 40 years. So guys, there's lots of down payment assistance programs that are out there, lots of ways that I can help you. All of them have a little bit different flavor to it. And that's where I'm an expert in helping you with these. But let's take a few minutes here. We've got about 10 minutes left. I want to try and wrap up by 8 o'clock. Let's take a few minutes and talk about what are the real options numerically. So first of all, let's pretend that we're buying a $500,000 home. Let's open up my handy dandy little spotlighter here. Perfect. All right. So let's pretend we're buying this $500,000 home, and you bought it for 500 grand. Your appreciation annually, house prices go up around 5% on average in California historically. And let's pretend you're going to sell or refinance in 5 years. So in 5 years, that house is worth $638,000. You have increased your net worth in 5 years by doing nothing but living, by doing nothing but paying a little bit more in your payment for shelter instead of what you're paying in rent right now. You've made $138,000 in the next 5 years. Now let's talk about what the monthly payment is going to be. So if you have the Dream for All program, you only had a payment of about $3,100 and you had about $22,000 out of pocket, or you might have done Dream for All with no closing costs, in which case you had about a $3,400 payment and you only needed about $2,000 out of pocket. But here's the deal. In 5 years, when you refinance or sell, you owe the state 20% of that 138. You owe them $27,000. Now, you saved about $600 a month compared to what you would have spent to buy this home with an FHA loan. So that did save you $36,000 in savings. So when you sell the house and you pay off the state, you get $98,000. Remember, you didn't have to spend this money. So that is wealth that you built. They say a penny saved is a penny earned. Well, this was a penny saved. With the Dream program, you saved monthly payments, therefore it was earned. You ended up with about $134,000 of total wealth building, or $101,000 if you did the option where you had less money out of pocket. But what are my options now, John? Well, let me show you. First of all, you can go with an FHA loan. Now, a regular old FHA loan, 3.5% down payment plus closing costs, you're going to get a much better interest rates, but you need a lot more cash out of pocket. Okay, so you're looking at now about $40,000 total between down payment and closing costs. But here's the good news. When you sell that house in 5 years for $638,000, you netted 144 grand. Now, yeah, you had to pay a little bit higher monthly payment. You're paying about $37.50 a month, but we just spent 10 minutes talking about how you can afford that higher monthly payment. So if you can find a way to afford that extra $500 or $600 a month, you've made 144,000 instead of 98,000. And remember, I'm not forgetting about the $600 a month that you saved, because that is real money. But even with that $600 a month, you only ended up $134,000 in wealth. You're way better off by putting your own down payment. You just have to come up with that $40,000. Okay, so that's the key question, is can you come up with the money? Now, what if you can't? Then let me show you an example using FHA with the Cal HAFA My Home Assistance Program. So now you're going to get 3.5% towards your down payment assistance. That's $17,500. But you still have about $23,000 worth of closing costs. Okay, the closing costs are more expensive when you're using down payment assistance. So now you got to come up with that 23 grand. But here's the deal. You're only paying $900 in interest. You make zero payment on this My Home Second, and you're only in 5 years, because your interest rate is 1%. You're only paying $900 to the state in interest. With the Dream for All, you paid $27,000 to the state in interest. So that's a big difference in how much money that you're paying for the assistance that you're getting. Now, you say, John, I want to, look at other options. How can we make this work? Well, you can get a seller credit and come up with your own down payment, and that way you're not borrowing any money. And now you end up with even more wealth, because now you've got $144,000 because all you did is negotiate for the seller to pay your down payment. But realistically, what most of my clients are doing is this last option. And that is that they are doing the 3% seller credit and the My Home Assistance Program. So with this scenario, you're only coming up with about $8,000 out of pockets. And if you went down this road, you're in a position where, again, you're only spending $896 over the 5 years for the interest on the $17,500, and you still end up $125,000 ahead. So pretty darn close. Even after you account for the monthly payment savings, you're really not that far off. The difference is, how can I afford the monthly payment? And here's the scary thing. So many people that were looking at the Dream for All could afford a higher monthly payment. They just didn't want to. They figured, why should I if I don't have to? But you're going to have more wealth building if you don't use the Dream for All program. With the FHA loan, you ended up $10,000 ahead, or with the seller credit, you're ending up $10,000 ahead of what you would have been under the Dream for All program. That's $2,000 a year. I don't know about you, but $2,000 a year is a lot of money. We're talking about $166 a month in simply the difference between, and everybody's worried about $500 or $600 a month in payment, and I get it, but your equity, your wealth building in the next 5 years, you're looking at the difference of $166 a month over that 5-year time frame, simply by putting your own down payment. So hopefully that made sense. Guys, I'm getting ready to wrap up, so I want to kind of talk about what happens from here. So if you have questions, feel free to post them right now. If you are ready to move forward and say, okay, I want to figure out what my options are. Well, the first step is to start with downloading my mobile app and giving me some information about you. I'm going to need to, I'll do a soft credit pull, so I'm not going to do a hard credit check. Do a soft credit pull. I'm going to take a look at your income. I'm going to take a look at your assets, and we're going to have a consultation. We're going to have a Zoom call or a phone call, or you can come into my office, depending upon what part of the state you're in. I've got an office in the Central Valley in Lodi, and in the Sacramento area in Roseville, or Zoom works well too. And so start by scanning this QR code, go into my website. If you download my mobile app, it's actually got a very handy calculator to run mortgage payments on there as well. And that's actually the best way to get started to figure out what your options are. The other thing I want to tell you is please subscribe to my YouTube channel. I actually have 2 channels. I left the other one off. But if you go to this YouTube channel, the John Loan King, about halfway down on the homepage, you're going to see a link to my California Dream for All page. That page is dedicated to first-time homebuyer programs. The California Dream for All page has so far been dedicated to only the Dream for All program, but I'm expanding it. It's going to be dedicated to helping first-time homebuyers figure out options to become a homeowner. This video tomorrow will be embedded into the Dream for All page. So I didn't give you the link to it, but if you scan here and go to my John Lone King YouTube channel, either go onto YouTube and search for @John Lone King or scan this QR code. Once you're on the John Lone King page and you subscribe to it, scroll halfway down the homepage and you'll see a link to my California Dream for All page. Gary asked, how much does the My Home loan interest increase if you're getting a jumbo loan over $725,000? Gary, that's a great question. So the My Home loan doesn't increase. The first mortgage does, and it increases by the same amount as the Dream for All did. So every day, Cal Haffa sets out their rate sheet, and the rate sheet says, hey, here's the interest rate for the normal conventional first. You can tie the My Home to a conventional or an FHA first mortgage. But when you do the conventional first mortgage, it says right below it, if it's a high balance loan, we're adding a fee. We're adding extra money for you to have to pay. Now, I got to tell you, in a high balance market, it's really tough to justify, hey, I'm getting 3% in help, but I have to pay 2% as an origination fee for all down payment assistance and an extra 1.5% for the high balance fee. It kind of makes it not logical. So I'm hard pressed to justify using My Home on high balance. You can, and sometimes it makes sense, but it makes it a lot less logical when you're spending 3% in fees to get 3 or 3.5% in assistance. Yes, you can use seller credits to help pay for that assistance. There's some ways that we can use some smoke and mirrors on numbers to move it into a different category. But in general, the My Home loan interest doesn't change. It's the interest on the first mortgage, and it matches exactly what the program details are with the Dream for All, where you're paying that extra fee up front. So hopefully that makes sense. All right, so don't forget to subscribe to my YouTube channel. Every month, the third Thursday of the month, I do a how to buy masterclass. So every one of you here is likely a first-time home buyer, because that's what the Dream for All program was designed for. You need to know how to buy a home. Each class covers, it's about 1.5 hours long. The next one is next Thursday, which is a week from today on the 20th. And I'm going to go from 7 until 8:30, unlike this one that's going to wrap up here at 8. And I cover every month where the market's at and what's going on, but then I cover a different part of the home buying process. So for previous months, I've done things like what's a lender look for and what are we doing to approve you? I've covered the escrow process. I'm going to be covering in the future inspections and how that part of the process works. We'll talk maybe down the road about the house buying and hunting process and some tips and tricks for how to get the most out of house buying. The idea behind these classes is that each one has a consistent theme of some basic things, but then it goes a little bit different direction so that you can search back through my library of master classes. I don't know. Master classes is who's my grammar person? Master classes is. I'm just kidding. Anyway, you can go back to the library of the master classes and you can pick and choose the portions of the ones that speak to you, that are areas that you're concerned about when it comes to the home buying process. Raina had a question here, and Raina said, if recently self-employed, would I have to wait until next year or 2 years from now to get income verified or qualified for any loans? So it depends on first of all, you typically have to have 2 years of being self-employed before I can count the income. If you were in a related industry, actually it was Jessica, it wasn't Raina, sorry. Jessica, your last name looked a lot like Raina's first name, and so that's what I keyed on. Anyway, Jessica, if you're in a similar industry, so let's say, for example, you were a dentist and then you opened a dental practice. Well, then it's kind of the same industry. Or if you were an attorney and then you opened up your own attorney's office, then your ability to qualify shrinks typically to 1 year because you have a history of being in the same industry. If you ran a local clothing store and you were the general manager and then they sold it to you and you owned it then, well, you kind of were doing the same thing. You were just doing it as an employee versus doing it as the owner. Now we can qualify you with just 1 year of history, but we look at the numbers really carefully. But it's typically 2 years, but we can qualify you with 1 if you have experience in a similar industry doing similar work. So yes, I hope that makes sense. Guys, I definitely want to answer questions, so please feel free. I know it's 8. I don't have a hard stop right now, but I want to stop it. I want to make sure I had about an hour's worth of content. So before I wrap up, make sure you're entering your questions into chat, or if you're watching recorded, enter your questions into the comments in YouTube. Otherwise, this really is where you start your journey. Go to my go to this website. You can also download it as a mobile app. Please make sure to subscribe to my YouTube channels, because that's really how I help push out information. I want to help you. If you don't buy today, I'm okay with that. I just want to be your guide through this journey. And so as you move forward, I'm going to sit down with you and I'm going to give you advice that isn't going to be pressured. It's going to be giving you the advice I'd give to my best friend, to my brother. I want to help guide you, but I want to also make sure look, I'm going to be in this industry for a long time. I've been doing this for 23 years. I'm only 25 years old. Can't tell by the gray hair. But the fact is that my goal is to make sure that I'm taking care of you when the time is right. And so don't feel like you're bugging me. Don't feel like hey, I'm not going to buy until next year. I shouldn't talk to John. It's actually more important to talk to me early, because there are things you didn't know. You're going to find out when you go to my masterclass. I'm going to actually go back up to the masterclass right now, because I really want all of you to register for my masterclass next week, next Thursday night, the 20th at 7 p.m. And you'll find out in my masterclass, there's things that we look for in a loan that you're like, oh yeah, I'm fine on that, until I actually pull your credit, or until I look at your income. And kind of like what Jessica was asking about, and saying, hey, what about my self-employment? When do I qualify? We have preconceived notions. We think, oh, I'm fine, or we think I'm not okay. And sometimes you're wrong. A lot of times you're right, but be careful the advice you take over the internet. Again, I'm preaching to you on the internet, but it's just like taking medical advice from somebody who has a similar ailment, and you take their pills. Their pill might kill you, because it has nothing to do with their medical history, and your medical history are totally different, and you could have an adverse reaction. So please join me in my masterclass. It's every month. It is on the 3rd Thursday of every single month. You can go to How to Buy Masterclass and register for it. Raina has a question. By the way, guys, I'm going to wrap up as soon as I finish with questions. So if you have a question, now is the time to post it. Raina says, what if I still want to gamble with the Cal Halfa loan? Where do I start? When do I start? And how long will that take? Honestly, we start now. We do a soft credit pull, and we make sure that you're qualified, and then we keep our ear to the ground. Because I had people who were qualified 3 weeks before this money was released, and they were ready. And they wrote an offer immediately, and we knew when the money was going to be released, and they were ready to pounce immediately. The other thing is home buyer education. The home buyer education is a major problem right now, and it's majorly backlogged. So wait until the backlog is caught up. Don't become part of the problem, but take your home buyer education. If you want to wait for the Cal Halfa dream money, get your education done. The education costs you $100, and it's good for a year. So once you get the education done, if you buy within the next 12 months, you get to not have to do education again. So that's a helpful way to think about what your next steps should be. But it really is, come sit with me. Again, I'm not going to do a hard credit report. I'm going to do a soft credit pull. We're going to make sure your credit looks good. I'm going to take a look at your income. I'm going to take a look at your qualifications. I'm going to make sure you're ready, so that we're ready to pull the trigger. As soon as the money is released, we're there. So Randy, you said, what about the counseling? I don't know if you missed, hopefully I wasn't breaking up. The counseling, okay, so the counseling wise, the counseling is good for a year. You can take the counseling now, but wait until the backlog of the people who are in it now. Spend the $100 and take the counseling. Hopefully that answers your question. If it didn't, ask it in a different way. Angelique says, is the masterclass for agents only or buyers too? As a matter of fact, Angelique, my focus is on buyers. So the masterclass is, I have a lot of realtors that come to my masterclass. I encourage you to. I'm speaking to the buyer. So I'm helping the buyer understand how to pick a real estate agent, what to look for in a real estate agent, Should I just go on Zillow or call the person whose name is on the sign and work with them? Pros and cons to all of that, and I'll talk all through that. But the masterclass for how to buy a home is specifically designed with the consumer, the home buyer, as my audience, and anybody can join. Realtors absolutely can join. I think they'll get a lot of benefit out of it. I see Michael asked a question. I'm going to jump to Angelique real quick. Yeah, so the 8-hour course, Angelique, I'm jumping to Raina real quick. The 8-hour course is what I'm talking about. There's actually 2 education pieces required for the Dream program. One has to do with shared appreciation. That's a 30-minute course. It's the 8-hour course and the counseling that I'm talking about that you want to get working on because it's good for a year. And I promise you, we're going to have a bottleneck again when money is released. And so you want to be ahead of that curve, and getting the counseling done, investing that $100 is well worth it. Michael said, can you shed some light on working with your team? Will we be working directly with you or with your team? That's a great question. So I am the only loan officer on my team. I've been doing this for 23 years, and I've really pride myself in building a great following of real estate agents and clients to take great care of me. And so I do have a couple people on my team. I have 3, as a matter of fact, on my team that help me serve you, but I'm the only one that's going to give you a consultation. So my team will help you in collecting documentation. They're going to, if you don't want to fill out your information on a mobile app, then they're going to talk to you on the phone and ask you for your birth date and your social security number. They're going to compile all of your paperwork for you, for me, and they're going to schedule a Zoom call for us to have a conversation. But you are talking to me. I'm going to be the one that gives you the advice. I'm going to be the one that locks in your interest rate. I'm going to be the one that tells you what program we should use. And then I'll be updating you regularly through the loan process. And even before that, while you're shopping for a home, I'll be calling periodically and checking in. So hopefully that helps answer your question. Feel free to ask more if you have questions. Anna, you have an appointment with me on Monday. I'm interested in an FHA loan. I absolutely can help you, and I'm super excited to be meeting with you on Monday. Thank you so much for being here tonight, and I'm really excited to meet you on Monday. Angelique, my clients took the class already. Should they do the counseling now? So which class are you talking about, Angelique? When you say they took the class, there's the 8-hour class, and then there's an hour of one-on-one counseling after that. That's all required to get one of the certificates. And then, yeah, so the 8-hour class, they took the 8-hour class, but they never had the counseling appointment at the end of it. Is that what you're saying? Because if they haven't, yes, they should schedule the counseling appointment. I would just wait until, like, look, here's the deal. I have buyers right now that are in tears, and I hate to say it, but I do. They're in escrow, supposed to close at the end of the month, and their counseling appointment is May the 2nd. And they cannot get the counseling agencies to give them a sooner counseling appointment. They're risking right now the seller canceling their escrow. That means they lose the money they spent on the appraisal, the money they spent on the home inspection. And so don't get in the way of that. The money's not available now. If you have a counseling appointment, cancel the appointment. Help out your fellow home buyer who was able to get the money secured, and help them get an earlier appointment. So if your clients took the class but didn't do the counseling appointment, give it 30 days before they schedule the appointment. Wait until late May to schedule the appointment, so that all the people who are in escrow right now, all of those need to close in April and May. So by the time we hit late May, those people have already been through counseling, and now get your counseling done. That certificate's good for a year. Raina says, do you have to be a non-homeowner to get into CalHFA? So no. First of all, it's a first-time home buyer. CalHFA, actually the My Home, all of the CalHFA programs do require being a first-time home buyer, not having owned a home in the last 3 years, owned your primary home in the last 3 years. But that's where the GSFA Platinum program comes in. A little bit different criteria, but the Platinum program does not require you to be a first-time home buyer. It offers similar benefits to CalHFA. Right now, I think CalHFA's My Home is a better deal than the GSFA Platinum, but that is, I'll explain all of that over the coming weeks as I dive deeper into each of the programs, and I'll be doing webinars that you'll be able to find on both of my YouTube channels on that. But the answer is, for CalHFA specifically, yes, you need to be a first-time home buyer, defined as having not owned your primary residence in the last 3 years. But I do have other down payment assistance programs that don't require you to be a first-time home buyer. All right, gang. Well, I am going to wrap up. We got probably 80% of people that joined are still here, so that's wonderful. I'm about 10 minutes late, and I still have not eaten dinner. So I'm going to let you all go. I'm going to head upstairs and spend some time with my lovely wife and children. And I really appreciate all of you. So I'm looking forward to those of you who are meeting with me soon or are already clients. Thank you for your trust. For those of you who are not, this is absolutely a job interview. I am interviewing to be your lender. So please, please, please give me that opportunity. Join my masterclass next week, and also make sure that you join me for or start the application process here as well. I really appreciate all of you, and I hope you have a wonderful evening. We'll talk to y'all soon. Good night.